Today I will talk about another conventional technique of capital budgeting, that is ARR, accounting rate of return. And ARR is after tax average annual accounting profit that generated from investment and divided by average investment. And that's ARR calculation formula is average after tax net profit divided by average investment that you see here. An average investment that we get from initial investment initial investment plus salvage value divided by 2. And this ARR decision criteria is if accounting rate of return is greater than or equal to targeted rate of return, then project is accepted, and if accounting rate of return is less than or equal to the target rate of return, then this project is rejected. And if you see the example of this, project A and project B, both have 10,000 initial investment and there are some profit. Project A 1 year 5,000, B 6,000 and as flows, and project B has only one profit, that is in year 1 5,000. And you can see here the salvage value only have 2,000. That means after all depreciation, the value of an asset. So we can find out here average investment, that is initial investment plus the salvage value divided by 2, that according to the rule, and you get the average investment 6,000 taka. And if you calculate the accounting rate of return of project A, then firstly you have to find out the average profit, that is you should add the awful profit that you get 25,000 taka, and then you will divide by 5, then you get average 5,000 after tax profit, and then divided by the initial investment, that is 6,000, and you will get 83% ARR. And you are trying to say that that's of all profit considered as after tax. Okay. Now if we calculate the accounting rate of project B, that is 5,000. So the average, there have only one profit, so it's the average 5,000 divided by initial investment, that is 6,000 from here, and then here you also get 83%. And if you consider the targeted profit is 80%, and projects are independent, then both projects will be accepted because that both are above the 80%. The accounting rate of return have some advantages and disadvantages. Firstly, we'll talk about the disadvantages of ARR, because of there are some disadvantages over the advantages. That is the first, ARR consider profit, not cash flow. Yes, we can see here it gets offer the profit, not the cash flow. Or we know that in cash flow have some problems, so that it can be biased, and profit that does not consider in time value of money, and profit have no reinvestment assumption, so that have some problem with profit, that profit here considered rather than cash flows. And second problem is it ignore time value of money. You can see here it does not consider the time value of money, and time value of money is the most important concept in the finance, but it does not consider here. Third one is it does not consider project life. Yes, it does not consider project life because of you see here in project A have a 5-year profit, but in project B have only 1 year profit. It is 5,000 taka, but both treatment are same. So it's ignore the project life and ignore farm value. Yes, we know that the objective of our study here is the maximize the farm value, but it consider profit, not the value of the farm, not like a cash flow. So it ignore the farm value, and that all this is not consistent with our objectives. So there are some advantages also for that we are still using this ARR that are here. You can see here the first of all advantage is that it can easily compute. Yes, you can see here it is a very easy rule. From this way you can easily calculate this accounting rate of return, and we know we are mostly interested on the rate of return. Generally, if you ask a person, then he generally you also ask me how much rate of return I can get from this investment. So most of the people interested with the interest rate, and that you get from here. So it is the one of the first advantages, and another is management reward system. Yes, you can easily compare the how much their management will perform, and they gain accounting rate of return, and from according to this you can give the reward to your management for their performance. So easily you can compare that because of accounting from this accounting rate of return. And last on advantages is ROI, report on shareholders return on investment. That's report you can easily make from the account rate of return, and after that you can easily make a report to your shareholders. So it's a very good good accountability of yours to your shareholders that you can make from your accounting rate of return. I think it's make your sense about accounting rate of return, and it's a very easy concept that you easy understand. And most of the book, some book it's included, or some books not included, but it's a very important concept that I discussed here. So thank you everybody.